Are you gonna?
Are they gonna put me on the front page?
Okay, so everybody here?
I just.
Everybody on the main page?
Yes, sir.
Okay. Everybody go to library? Library?
Yep.
Okay. So go to library, go to search. Over here, you guys want to follow along. And then go to databases. You guys haven't done this?
We did.
I've used the databases before.
Have you? Go. And then type in merge it. There. Go to search.
We have good databases
Bing,
for
bing, bing, bing.
publicly posted journals
You guys have merge it.
that you usually wouldn't be able to
You guys
access.
have mergent, okay? You probably want to write this down. You have mergent. That's all you have, okay? You don't have S&P net advantage. You need to write this down. Finance, what's your major? What's your concentration? What's your concentration? Finance, okay, you need to write this down. Okay. S&P net advantage. Okay, it's also called net IQ. So we got mergent, S&P 500 net advantage, Morningstar. Morningstar. Okay. Value line.
We don't have Morningstar access.
You don't have any of those. You only have mergent.
You can use it for the
You want to write down IBIS, 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 IBIS. Those are industry ratios. And S&P also provides industry ratios too. You can also use stock charts, big charts. I mean, those are others. NASDAQ. These are all resources, right? But to conduct financial analysis on companies, industries, particularly companies, you need mergent, you need S&P, you need value line, and you need Morningstar. You guys don't have this. You just have mergent. All right? So you have
old NASDAQ.
you have one can tied behind your back. You don't have multiple sources of financial information. Okay? So click on mergent. Okay, here you go. So what I did was, I've already brought up some of these. What I'm doing in the other class and what you can do in this class is you can pull up the individual companies. So we're doing banking in 305. We're valuing JP Morgan. Okay. So you can put in the ticker. What's JP Morgan's ticker?
JPM.
Yeah, JPM. So you stick in JPM. Or actually, when you start putting it in, oops, that's not what I wanted to do. JP, there it is. So JP Morgan Chase Holdings, New York Stock Exchange.
Okay, good.
So you click on it, and there's your first. What I do is I basically copy. I put in all of my companies, opened up a bunch of windows, used this one as the main, place to put in the tickers for all my 25 companies. Opened up 25 tabs, copied over the URLs. So now I have basically JP Morgan, I got Citigroup, I got Bank of America, I got Wells Fargo, and I got Goldman Sachs. So that's basically my peer group. And JP Morgan's our target. That's what we're trying to value. You've got 25 stocks. Okay. So from here, very quickly, you can get the EPS, right? You can get market cap. We can go over. This will give you some of the key, data right here. Where you want to go is you want to go into company financials. Now I got the balance sheet. I can do the income statement. I can go back 5 years. I can go back as far as I want. What I wanted to do for the other classes, I go to income statement, and we're going to go back as far as we can, and I want to hit refresh. And now basically I have the income statement on an annual basis going back to 1982. Okay. So what I can do is go down here to the bottom, and I basically have my, where is it? Oops, the income statement. Income statement, annual. Earnings per share, right there. So there's my earnings per share basic. So what I can do is I can print that out, export it as an Excel, and I can calculate the year-to-year change in earnings per share going back to 1982. Would that be valuable? Yeah. Could I create a histogram out of it? Calculate the expected earnings per share growth rates? Can I use the constant growth rates as a guide to my Gordon growth model? Constant growth rates? Yeah. Can I use the normal distribution of earnings per share to get an expected earnings per share growth rate? Yeah. Can I go back in time? Let's say through the 80s, 90s, 2000, 2010, 2010 to 2019, and basically get decades of growth rates and earnings per share, and identify the recession periods, the recovery periods, the growth peak periods, and the decline periods, going back 4 business cycles. Can I do that? And where are we now in the business cycle? Are we in a decline phase? Are we falling into a recession?
Yes.
Are we?
Not yet.
Not yet.
Yeah, we're peaking.
Nope. Are we in a recession?
No.
Nope. Are we in the most recent period right after a recession?
No.
No.
So where are we? Yeah, we're in the growth peak phase. So can I go back 40 years and just look at the growth peak phase of each cycle and use that as a guide of what earnings per share growth rates could be over the next 5 years, looking back at a cycle, Yeah, we can use history as an indicator of the future. And can I also use the most recent 3 years of earnings per share as a guide to earnings per share growth rate momentum?
Yes.
Yeah, absolutely. I can build a multi-factor model using multiple factors and create a regression model to forecast earnings per share. I can do that. I could use an exponential smoothing model using Holtz-Winter's exponential smoothing models to be able to project out what the earnings per share growth rates are going to be over the next 4 quarters. I can do that too. I can use an economic model, cycle model, just like I described, to be able to forecast what earnings per share is going to be, not only next year and the following year, but over the next 6 years. Can I do that? Yeah. Or what I can do is I can project and put together a pro forma income statement and basically go through the whole accounting line items for each line item within the income statement to come up with the earnings per share. Can I do that too? Yeah. So there's multiple ways of being able to come up with forward-looking earnings per share for your fundamental securities model for valuation. Okay. So that's where you would get the data. All right. Where you can click on standardized. Is that what we did? Standardized. Yep. Standardized. So the standardized is going to be the EPS. And then here's the financial ratios. So I got ROA, ROE, profit margin, debt to equity. These are some of the financial ratios. What I can do is, what I would do is I would set up these for all 25 of my companies. What I would do is click on this button right here. You see this button right here? This. So when I pull up the company, I click on it. company one is added to the list. I got Citigroup, click on that. Company two is added to the list. Bank of America, click on it, is added to the list. Wells Fargo, click on it, is added to the list. Goldman Sachs, click on it, is added to the list. Now click on that where it says company analysis list. You basically have your companies right here. Okay. Then what you're going to do is you're going to bring the companies over.
Are we doing this in our portfolios?
Yeah, you can do that for your stuff. I'm not making you do all this stuff. I'm not making you do fundamental securities analysis for all 25 of your stocks. But through this, you'd be able to export all of the data that you need to pump out the 25 reports if you had to.
Yeah.
Okay. What you're doing, the assumption is that you took my, 305 class. So you know how to do the intrinsic valuation work, which are these reports. If you want, you guys can take a look at these. But I'm not making you do these,
Yeah.
although I should make you do these.
Correct, you can get it out, but,
That's probably
but what,
So these are the individual stock valuation reports that you do for all 25 of your stocks. Okay? And then you would, as the equity analyst and portfolio manager,
Alright, we got the
would
first
basically
six.
talk through these, refine them, and come up with your premiums and discounts. If you guys want to do one of these, tell me, and we'll do it. All right, we can do one stock, so that when you walk out of the class, you have this, the memos, the passive portfolio, the active portfolio, target portfolio,
Okay.
and the report. So now you have product, you can show somebody. Can you show somebody this stuff and get an internship? Do you think they do this at Berkeley? No, they don't do this at Berkeley. Okay. The Berkeley people don't show up for interviews with a portfolio of stuff. They just talk about what they did. USF and St. Mary's, my schools, they got a portfolio of work. It's like, show me some stuff that you've done. Oh, and I brought you an extra copy. Color, found it. Okay, so let's go through it. So here, company financials. All right, so I don't want preliminary numbers, I want as reported. I want the final reporting numbers. And I'll go back 5 years. Ratios. I want the ratios. I want the financials. Okay, I'll take those. What else do we got? Pricing information. Earnings per share. PE ratios, I like those. Price changes. Would that be helpful?
Absolutely.
Yeah, because can I calculate a histogram for a normal distribution to look at what the expected return is on the stock, using basically percentage changes on an annual basis for that for 30 years?
Analyze those trends as well.
Wouldn't that be awesome? So let's just start with those. Okay. Then what you're going to do is select a format. You're going to go Excel, and then you're going to create a multiple company report. I don't know why this is doing this to me. What?
Too much data.
Is it?
I don't know.
I think I'm not sure if you did this on the last page, but at the top you have to punch over what companies you want.
I did.
Okay. Because I just got kicked out.
Oh, did you?
which format did you choose?
But then save.
Yeah, what I did was I brought over all these. Let's just do a few of these things.
Sounds like, it seems like their server's down.
Oh, is that what it is?
Yeah, it says that there's a server error.
Okay, so let's just do the financial ones. So Excel, and then Yeah, so I'm getting a server error. Maybe it'll come up later. But that's how I would export the data that you need. So you could have done this for, you may want to go back and do some of this stuff for your EPS projections. Look at the multiples. Okay, what were the multiples? Late stage for these companies? Because the multiples are just standardized measures, right? You could, if you wanted to, if you got the long-term debt and you got the owner's equity and you summed them up and took the owner's equity and divided it by the total long-term debt plus the owner's equity, I could get the weight of the owner's equity minus 1 and get the weight of the debt. I can also go up in here and I could look at, where is it? Is it reports? Yeah, no. Company financials. Analysis. There's a place here. Oh, here we go. Long-term debt. So I can go to long-term debt, and very quickly I can get a survey of their debt issuances. Oh, this is called, I want to do JP Morgan. In here, because when I calculate the weighted average cost of capital to come up with the discount rate, right? And I can use CAPM, I can get the beta times the return on the market minus the risk-free rate, plus the risk-free rate. I can get the expected cost of the equity using CAPM. If I know the cost of the debt, and I know the cost of the equity, and I know the weights, I can calculate the weighted average cost of capital, not taking into consideration the tax shield, right? You want to have the cost of the debt, 1 minus the tax rate. I could do that too from this. I can get the, but how do you get the cost of the debt? So you go back and you look at what the cost of the debt was based on their bond issuance, most recent bond issuance. And you can see that here's a senior debt. These are two senior debt. One's fixed, one's variable. But their cost of debt looks like around 6.4%. That seems a little high, actually. Yeah. Here's their subordinated debt, fixed and variable, at 8%. This seems a little high to me. But it gives you kind of an idea. And maybe you Google or you go to some other source and you look at what the JP Morgan 7, 8, 9, or 10-year bond, corporate bonds are trading at on a yield to maturity basis to get a proxy cost of debt. Okay. What else? What else do we need to analyze the companies? I can also get the PE multiples. Isn't there PE? Here's the PE. So I could look at the historical PEs, look at the current PEs, to be able to project out what the PEs are going to be next year, which you did in your fundamentals. So I could use that too. What else did we use? I could look at the constant growth rates of earnings per share to get the terminal growth rate, to calculate the terminal value. I can use that too. So you may want to use these, go back and do a little bit more analysis, you fundamental analysts, and to see if you can add a little bit more precision to your fundamental securities analysis.
What happens if the premium's higher than 20%?
You have to ask yourself, can the stock price go up that much? Has the stock price ever gone up that much? Is the stock price that much undervalued? Has the stock price been basically oversold, the most recent period where it's basically bouncing off the support, and you just read that it's going to be introducing a series of new products that's going to drive revenue and earnings growth over the next 3 years. So basically, the revenue projections and the earning projections don't even take into consideration growth in earnings per share over the next 3 years based on new product lines that they're introducing. So you have to, the best forecasts are a combination of fundamental and technical securities analysis. Okay, any other questions? Okay, portfolio managers, you're on. You're up. Okay, everybody know how to use margin?
Yes.
Okay. I bet you were already win,
Yeah, all right.
unless you want to go
I
again.
thought that was like a prelim, but
Go for it.
I'm cool with.
Go for it, I think
I would love to.
you kind of set
but
the standards, so, and then how long is the presentation?
Just an update.
Yeah, so why don't you just do it? Because it's easy. Who's going second? Okay, who's going third? Who's going fourth?
Yeah, can I use your?
And then Douglas, Phil.
Plug in.
Okay, who's going sixth? For fundamentals. Fundamental securities analysts. Who's going sixth?
President, I
Yes.
don't have the PowerPoint, but do you still want me to go?
Yeah, I still want you to go. And then you can do the PowerPoint later.
I want to fix my numbers because I'm
Okay. Who else? Fundamental securities analysts. Okay, cool. So you guys aren't going, but now that you know how to use merging, you can go back and check your numbers. And add more precision to your fundamental securities analysis and come back on Thursday and make the presentation. Awesome. Technicians. Okay? Are you guys ready to go or are you gonna go on Thursday? Okay. Who else? Yeah, you're ready to go too. You're gonna have the PowerPoint too, right?
Yeah.
Okay. Who else is going? Okay. Steve, go ahead.
Yeah. Yeah.
Okay, did everybody take pictures of these? Yeah. And don't steal them from me. 'Cause there's no one else. Are you presenting? When do you present? When do you present?
Bad timing.
Okay, awesome.
Great. My friend just told me that she's sick.
Awesome.
Yeah. Believe that little 3 bars.
Is everybody ready?
Send me the or just take. It's gonna be
You guys have like 7 in your.
I don't know.
Oh, what?
I'll take them for you.
This is crazy.
I'm just
Ready
I
to
just
hear?
like. I know I'm not gonna send them to you.
Yeah.
I guess that's like the only thing far away.
Well, Steve, I thought was good.
I'm trying to get it onto a similar machine, that way I don't have compatibility issues with the Mac.
Got it.
I mean, Windows, Mac
Okay.
or Windows.
Are you going to tell us how to do the PowerPoint for technical?
I did.
No, we didn't.
I'll do it when Colby does his presentation.
17,000.
And fundamental. I sent you.
Technical. He's
Yeah.
technical.
But
I just need one technical person who's already finished. And I can go through their presentation and tell you exactly what our point's gonna look like. Are you finished with your technical analysis?
Not.
Okay, is anybody finished with their technical analysis? Are you done?
Yeah.
Can you do the presentation tonight so I can tell everybody what the PowerPoint looks like? Yeah, okay. Yeah, that's cool. So you guys can go after this.
I'm pretty good.
Did you put the fundamental analysis in there too? Okay, cool.
But they make a lot of money, so.
2 for 1.
Where on my
To go ahead.
What would you pick?
money? I think I can't play. Alright, money. Man, I just thought it would be easy for you to send because you have my number already.
Yeah, I thought that's it. I just thought it's probably instead of no. It's my favorite class.
Hurry. Get ready to present. Need some boost.
Good evening, everybody. My name is Stephen Peterson, and I will be presenting an updated update slideshow for our actively managed large cap defensive portfolio. This is going to be an update from our passive. We've gone ahead and optimized it using quadratic optimization in Excel using Solver. Our recommendation is that DTC launch a new series of both retail and institutional large cap active growth portfolio products. And we target that this portfolio will have moderate to high returns of 11 to 19% with low to moderate risk with a beta of 0.75. We're looking to raise $2 billion in 5 years, or $2 billion, excuse me, in the next 5 years with our institutional investors. Going to see that in, we want them to hold on to it 15 plus years, and then while we're for the retail clients 5 years, excuse me. We will be charging a 1% fee of under that $2 billion, so it's going to give us a revenue of $20 million. Our outline is as follows. I'm going to go over the portfolio recommendation, the holdings, the past performance, our target market, fee structure, and then wrap it up with who we are, what we're about. So our overview is mainly consumer defensive, tilting, and then we also have that technology component with the healthcare. It's giving it that defensive structure to it. All of our holdings are large cap, and our largest holdings here, these are the 9 stocks after we optimized our passive portfolio. These are the only 9 that came through with the weights there. Up top we have Microsoft, Johnson & Johnson, Hormel Foods Corp, AMT, American Tower, excuse me, Boston Scientific, NVIDIA, Starbucks, MasterCard, and VMware. See our performance dates. We did a 10-year back test, and then we forward projected it. On the 10-year, we have a 15% return, and on the forward end, we have a 23% return. All of these back tests have beat and outperformed the benchmark of the S&P with a smaller beta of 0.75 to the S&P's 1. Target market, we're going to do a 50-50 split between the institutional and retail investors. Again, we're going to be raising $2 billion within 5 years. And we would like 4 to 5 years for our retail and 15 to 30 for the holding periods. We're targeting investors that are looking for long-term returns that are stable, such as retirement accounts, 401ks, excuse me, IRAs, and we can convert this into an ETF if needed down the line, depending on the market, what their needs and wants are. Our fee structure, as mentioned, we're going to be charging 1% AUM. It's going to give us $20 million revenue. series of both retail and institutional large cap active growth portfolio products, and we're targeting our investors, institutional and retail, 50-50 split, or $2 billion, giving us $20 million revenue per year. And again, my name is Stephen Peterson. I'm the portfolio manager, and I've been backed up with the research of my two equity analysts, Henry Fan and Colby Pratt. Next week, we'll be presenting another slideshow that has our research backed up to how we got to these numbers, why we got to these numbers, and how we're going to keep that going forward so we can continue to deliver above average results. Thank you.
So what I would do is swap on the major holdings, bring Starbucks up. There's like 3.64, so put Starbucks above it. And so everything's in descending order.
We've also made some.
I would increase the fee structure.
Okay.
Maybe by 25 or 50 basis points, because it's an active portfolio as opposed to passive.
Right on.
And we've made some formatting improvements on the old PowerPoint that I think we should incorporate.
This would be great for next week's presentation.
Yeah, you might want to put in the efficient frontier too.
On there? You got it?
Yeah, because yours looks really nice. You might want to put that in there.
Okay. I will.
All right. So, who are the portfolio managers?
Ronnie Boyd?
Yes. But I wanted to ask you,
Oh, sorry.
is your PowerPoint presentation, does it look as good as that? Not the same? Okay. Yeah, so there might be some, yeah, or just, all the data's in there and it looks like that, it's all, okay.
Wait, Steve, how did you do this?
I just want to make sure
Just plug it in.
everybody.
Yeah, just plugged it in, but it might take a little bit of finessing. Just seems like an older cable.
That's okay, I don't blame you.
Thank you. Yeah, you might have to try to reinsert as well.
Oh, I think you're gonna get, oh, they, hit the HDMI button.
Can I log in on Gmail?
Are you, you're using Apple?
Yeah.
Did you pull out and put in the HDMI?
Yeah.
Is it selected on the box on
There
the
it is.
wall?
You might have it.
Yeah, it's on the wall.
Oh yeah, it's Did you blow in it?
There's not a toggle in Apple that
No.
it would just pick it up
should read
automatically.
Yeah.
Do you know Maxo Cream? What is it? Maxo Cream. I'm the same with that.
Is somebody else ready to go?
We already gotta get like a couple things ready, 5 minutes.
Okay, Douglas, are you ready? Yes. Yes, while they're waiting, you can plug yours in and get it ready. Because she might have to pull it up on the desktop. Were you gonna pull it up on the desktop or the laptop? Okay. Anybody have a laptop? Were you gonna do yours on the desktop too? This one?
Did you airplay yours? How'd you get it there?
Take you on.
Oh, should I?
Should I put it to PC?
Yeah. Oh, cool.
Okay. So my name is Julia. This is our Derivative Trading Corp large cap diversified portfolio.
So we recommend DTC launch a series of retail, institutional, large cap portfolio products. Sorry. We target moderate to high risk and moderate to high returns, and we're looking at 14 to 18% return with our new active portfolio, and the totaling around 3.5 billion in AUM over the next 3 to 5 years. And our fee structure is 1%, generating a total annual gross fee of 35 million. In the presentation, I'm going to be going through the recommendations we have, the portfolio performance, and sector allocation and major holdings. So, with our new active portfolio, we're looking at consumer goods being the biggest section of our portfolio, so that's 39%, and then healthcare right under that at 27%, tech at 19%, and then two smaller ones, financials and defense. And this is still a large cap only portfolio. And the top four, sorry, that's numbered wrong. It should be top 5 of our holdings. Estee Lauder Company having 26%, Pfizer 20%, Facebook 12%, McDonald's 9%, and Microsoft 7%. So Estee Lauder having the greatest percentage in this. This is the expected performance, and again, the portfolio return is expected to be around 14% to 18%, and generating roughly 600 to 700 basis points. The target market is 50-50 between institutional and retail investors, and again, the target AUM is 3.5 billion per portfolio in that 5-year period. Our fee structure breakdown, the AUM of 3.5 billion with that 1% will again bring that revenue at 35 million. And we recommend that this retail institutional large cap portfolio with this moderate to high risk of 14 to 18%, that's a rather high return. So we're targeting investor segments that are institutional and retail clients and targeting a 35 billion return. And my name is Julia again. I am the portfolio manager, and my 2 associates and analysts will be presenting more information to back up these claims later. Thank you.
Okay, so it's going to begin.
Yes.
And get a little bit of feedback.
Okay.
First, I think your expected returns are a little bit high, so we'll correct for those.
Okay.
So go to the next one. Next one. And you're gonna fix that.
Yeah, I'm gonna fix that. I apologize.
Okay. Don't do that.
I know. Okay.
Go to the
Next one.
Okay, so your expected rate of return right here is 14% over a 10-year period.
Mm-hmm.
So I would use 12 to 14.
Okay.
Okay, and then your basis points, you said 600 to 700. But your 10-year is basically 300. So I would just say 2 to 300.
Okay.
You're weighting these too much.
Okay. Okay.
And then the next one. And then next one. I think when you do an active portfolios, you want to charge higher fees.
Okay.
So I would say at least 125 to 150 basis points. Okay. Those are still a little high, but you want to be able to show the fee differences between the passive and the active.
Okay.
Because you're taking on more risk.
Yeah.
When you do an active portfolio. Right?
Yeah.
Okay. Next one. Next one. And that's it.
So for this,
Oh, and then you want to make sure that you put in the efficient frontier.
Oh, gotcha. From the portfolio.
Yeah, because you want to show that it's an active portfolio strategy as opposed to a passive.
So I would have that in my PowerPoint?
Yeah, you would throw that in to the
Okay.
PowerPoint.
And then reduce the expected return?
Yeah, change the expected return to 12 to 14.
Okay.
instead of 14 to 18.
Oh, yeah, okay,
And it's a little too aggressive.
okay.
And if you want to show me your efficient frontier graph first before you
10
put it in,
employee processes.
we'll take a look at it.
Okay.
Okay? Because I know we were working out some.
Yeah,
some
I'll
things.
show you.
Okay, you guys ready?
I think if just the 30 or just the 10 cross, it's a lot. If they both cross the 50, it's a 6. 30 is a confirmation, so no 10 goes first. Yeah. Well, 10 and the 30 detention cross, yeah. It's the medium between the trend confirming the short-term trend. Right. Wait, so why do you have a black here? This is right there. Oh, the dates are going backwards. See, this is like June. Jesus. Oh, mine are too. Mine are too. So my cell should be here.
And don't forget to speak loud and project. Remember, you're like high-powered Wall Street traders, portfolio managers, you gotta have an attitude.
Okay. Good evening, everyone. We're Derivative Trading Corp. I'm Rex Yoshida, the portfolio manager.
And I'm Juan Ardani, technical analyst.
Today, oh, shit, my bad. Yeah, today we'll be presenting our large cap tech and defense diversified actively managed portfolio. So our recommendation is, yeah, we recommended a series of retail and institutional large cap portfolio products with moderate to low risk at a 0.8 beta and moderate to high returns of 13 to 15% over the holding period. And we are targeting institutional and retail clients, hoping to raise a 50-50 split between the two, totaling $2 billion. And we're with a fee structure of 1% to generate annual gross fees of $20 million. That's our outline. Foundation, sector holdings, portfolio performance, target market, technical analysis, fee structure, recommendation, and the credit to the team. So our portfolio is comprised largely of tech and defense, and we also have some tobacco, retail, healthcare, and airlines, and then it's comprised exclusively of large cap stocks. Our largest holdings are Microsoft, Universal Corp, CVS.
So,
I have the,
how's
I think it's Northrop. Yeah, Northrop Grumman Corporation and AT&T. I think that, yeah, I had to put the ticker because the name was a bit long, but yeah. And so here we have the test and the future projections for our portfolio against the S&P. And as you can see, we've consistently outperformed the S&P, except for our forward test. But thank you. It's been, yeah, we were able to generate a considerable alpha through our back tests, 10-year back tests, and as well as our forward tests. So, like I said, a 50-50 split between retail and institutional investors, with a target AUM of $2 billion per portfolio within 5 years. And we're targeting investors starting long-term returns, like pension funds and or company retirement accounts, 401ks, IRAs, and ETFs, as well as pension funds and endowments, family offices, and high and ultra-high net worth individuals.
And I'm going to talk about the technical analysis. So stocks to are Amazon, Walmart, Lockheed, and Microsoft. These are for a couple reasons. One is that they have a lot of upward momentum in their simple moving averages, so they're just constantly growing. And another is just market conditions. So for Lockheed we have an environment where defense is just doing really well with Trump, and then the other one is consistently strong performance in the market. And stocks not to wait are Altria, Universal, Philip Morris, and Boeing. Boeing is just not doing well, and the other ones are just have a lot of downward momentum. This is Altria, and have a lot of just regulation coming. And in terms of performance for active versus passive, I'm going to walk you through the analysis. So the passive actually did better. Here are the returns from the passive portfolio per year. And here are the numbers from the active portfolio. Here are the numbers from the active. So the passive was actually higher every year, and they all dipped by year 3.
So our fee structure breakdown is 1% of of the total portfolio of $2 billion, targeting 20 million annual gross fees. And to address the previous presentations, the reason we targeted such a low fee structure is to create a cost competitive advantage against other competing actively managed portfolios. And yeah, to reiterate our recommendation, our recommendation is a portfolio comprised of large cap stocks with a moderate to low risk 0.8 beta, as well as moderate to high returns of 13 to 15%, with raising a total of $2 billion over 5 years, with a 50-50 split between retail and institutional investors. And we plan to charge have a fee structure of 1%, generating $20 million over the holding period, or annually. I'm the portfolio manager, Rex Yoshida.
And Juan Redoni, the technical securities analyst. And next week our fundamental securities analyst will present.
So the fee structure, the fees need to be a little bit higher. Okay, and your expected returns and your alphas are too high, so we got to go back and adjust those. So you want to use 12 to 13%, or 12 to 14%. Okay, on the expected portfolio returns, and you can't have alphas between 500 and 1700. That doesn't work. So I would say between 2 and 400. Okay, and then will you take us to your technical analysis?
Yeah.
Okay, I would put in the actual stocks, the stock prices. Yeah, and then what you want to do is you want to put in, indicate where the signals are and the prices of what you bought and sold. Okay, just to give some example of the actual technical trading rules that you went through. You probably want to talk too about the any supports, resistance, trend lines, any consolidation, sideways patterns. Talk about any trends in volume and RSI and MACD. Okay, and take us to the profit and loss statement. So what you want to do is the second slide of your technical analysis, the first is going to be the cover page. What you probably want to do is show us this, right? Isn't that the most important thing? Right. And you basically, this was based off of the passive.
This is the passive, yeah.
Yeah, so you probably want to show us the number of shares per stock, sorted from high to low, so we know what stocks we're trading. And it would be interesting to see also the number of trades per stock, so you get an idea of where the majority of the trading revenue came from, not only based on number of shares, but number of trades.
You can sort them by number of trades on a
You could have,
different tab.
yeah, you could have them next to each other, and one would be,
Yeah.
the number of shares from high to low and the number of trades from high to low. So very quickly you can kind of see where the majority of the trading revenue, came from. And then what you're going to do is you're going to basically show on the second, what I would do is on the second slide I would show just a sampling. Go back to the worksheet. Because some technical analysts ask me what should be in the technical presentation. So you want to basically go this way, over here.
No, the other side.
Yeah. And then make sure you format all this stuff because you got all these gaps right here. And then just take a picture of like 4 of these plus the bottom and put that into the PowerPoint so that the person you're talking to can see how basically you set up the trades, okay? And then you're going to go do the charts. And then maybe show me maybe 1 or 2 stocks, that you're recommending maybe a overweight because of the strong upward trends, right? Such as Microsoft is a good one for that. Other ones you have a neutral on it because it's basically in a trading range. Maybe it's been went up, it's been trading sideways for some time. You're not going to overweight that. And then maybe there's another one that you showed earlier that actually was in a downward pattern with strong downward trend. That would be one that you underweight based on the technicals. So you're kind of walking us through, how you conducted the technical analysis and how you gave input, to your portfolio manager on what stocks to overweight and underweight and which ones that were neutral. So giving kind of a sampling. And then the last slide in the presentation should be your profit box again, right? Because isn't that the most important? How much you made on average over the last 3 years. And how much did you make on average over the last 3 years? It's like $100 grand a year. Over 3 years, you made 300 grand on $1 million. Is that a pretty good return?
Yes, sir.
Yeah. On top of the return that he was making based on the portfolio.
Now, would it be beneficial to add cumulative?
You could do that if you wanted to. I didn't. But yeah, you could do that too. I mean, there's different types of benchmarks. I just kept it simple. I said, here's our $1 million portfolio. Here's the performance on the passive. Here's the performance on the active. Oh, and we happen to have a trading strategy too that creates alpha, in conjunction with the other strategies. And then the fundamental analyst is going to walk us through how they use fundamental analysis to make money. And we can sell the research. And we can go long and we can go short. And we can buy on margin and we can sell short. And we can write and buy the puts and the calls. So basically through the portfolio trading system, we have multiple methods to be able to make money for us and our clients. And at some point in time, your company basically becomes a hedge fund. And you're putting up your own money as a partner in these types of products that you're inventing. You're co-investing with your clients because the first thing they're going to ask you is, have you put some of your money into this? And what's the answer going to be?
All of it, yes.
Have you put any money into these portfolios? Have you invested your own money into these portfolios?
Yes.
What's the answer?
Yes.
Okay, that's not an answer. Have you put any of your own money into these portfolios?
No.
Yeah, exactly. Yeah. Because if you haven't, then they're not gonna invest with you.
I thought the answer was no. I'm like, what?
Yeah, why would they invest in your portfolio when you can't even put your own money into the portfolio? When you don't even believe it enough to put your own money in. Okay, thank you. Okay, who's going next? How are you doing on time?
35 minutes.
We got enough for 2 more presentations. Did you guys give me back the fundamental analysis?
this room, unfortunately. Super.
And hit the button again behind you.
Okay, I'm still signing.
Okay.
Let's go. Perfect. Oh, we have to.
It was up till 3:30 yesterday, really. This stream perfection. I find that once 10 p.m. hits, that's like optimal working time.
Okay, I'm a little sick, so bear with me. This is, we are DTC, and this is our actively managed large cap portfolio. I'm Megan, and then everyone else you'll hear from next week. We recommend this portfolio that's diversified by tech, defense, healthcare, consumer goods, and financials. We target moderate to high returns of 9 to 11% with low to moderate risk. Our target investor segments are institutional retail clients who will earn 50-50 split for $2.5 billion total assets under management within 5+ years. The desired holding period are 5 to 7 years for retail investors and 15 to 30% for institutional. Our fee will be 1% of the total assets under management, which will equate to $25 million. This is the overview of our portfolio. It's primarily tech. The next largest would be insurance, entertainment, and so on. It is also all large cap. Our largest holdings were given to SAP, NVDA, NextEra, United Healthcare, and MSA. This is how our portfolio did. If you just disregard the forward month, that's fine. And then it generated an average of 200 to 300 basis points in returns over a 10-year period with the beta 0.1 lower than the benchmark. Our target market, again, is retail institutional investors with a 50-50 split. The target assets under management is $2.5 billion per portfolio within 6 years. Desired holding periods are 5+ years for retail and 15+ for institutional. And this is an optimal portfolio for target investors who desire stable long-term returns. Once again, this is our fee structure. It's 1% of the total, so that's $25 million. And then in conclusion, once more, we recommend this portfolio diversified by tech, defense, healthcare, consumer goods, and financials. We target moderate to high returns of 9 to 11% with a low moderate risk of a beta of 0.9%. Our target investor segments are institutional and retail clients who will earn a 50-50 split, $2.5 billion, total assets under management within 5+ years. The desired holding periods, once again, are 5 to 7 years for retail investors and 15 to 30 for institutional. Our fee will be 1% assets under management, so that will be $25 million in our pocket. Again, I'm Megan Flood. Yeah, there's 5 of us. We did approve that. And then you'll hear from Lay, Zendong, Mavis, and Yuhan next week. Well, this Thursday, rather. But, so, that's it.
Steve, can you send send her your PowerPoint presentation.
Absolutely.
You want to get your PowerPoint presentation from Steve and use that as the template.
Okay.
You have too much formatting you need to do.
Okay.
And then you got to give us an idea of what the portfolio is on the first slide.
Okay.
It's okay.
And double check your fee structure
Yeah, it
and your outlook.
glitched over,
Steve,
yeah, I
yeah.
know.
I don't know if you want me to
And
submit
double check the returns.
the
too.
digital format of our previous PowerPoint that we
actually is what it
changed,
is.
like
I
the
don't know.
Or
format.
use like the
Or
5
if you want to just
to
look at the
10
printout when he gives it back.
Oh, okay.
For the
Yeah,
expected
I can do
return
that.
in the offer.
Yeah, maybe just look at the printout and make changes accordingly. I noticed a few that he just like made me correct. You know?
Yeah, don't do that yet.
When I make mine, it's just gonna be
Do it
based.
separate.
Actually, no, I'll probably
Yeah.
present you or.
Yeah, because
I don't
those
know how
guys
that's
are
gonna
getting ready
work.
to do their
We should merge.
target port.
Yeah,
You guys are
probably.
already shooting for the target. Yeah, they're shooting for the target. That's correct.
This is taking me forever.
Julia, did you have a question?
No.
Do you have a comment? Okay.
This is taking me so forever.
I pay attention. I'm like so like,
And it's taking me for fucking ever.
Nope, show me the
But it's easy.
It's just like
Yeah, you're gonna get
Yeah.
the memo?
and seeing when the colors change.
Yeah,
I can figure out how to program it.
And seeing when the colors.
Actually, a lot of people are.
Really?
You looked at everything, you know. what
Cold.
means.
Yeah, it's different than.
Actually, that was kind of cool, which I
That's kind of fun.
think I'm
And
hoping.
I guess it's better than like a chuckle.
He's got the
yeah, I don't
memo.
know shit.
And he's got
I
the-
don't have them.
the Excel.
Didn't get to see on the
And
best.
then what he did is he actually, oh, that's how.
Yeah,
That's the.
I walked because I wanted
This
to
is
get
the
boba.
report.
Oh, we got boba too.
You did?
We got boba, guys.
Oh.
If you give me.
Yeah, that's a better boba. Little sweet.
Oh.
Little sweets like
We went
like
to
it's just gonna
Corn.
be, yeah.
Honestly, it's pretty solid though.
Little Speak is good. Where he don't Little Speak.
Yeah, you're hating too much.
That's my first time eating it, so.
No, you definitely did that before.
It's actually good.
When I said I like the Thai tea, I definitely heard it before.
So is anybody else going tonight? Anybody else
I wanna see the power.
going? Gone. Okay, guys. You're on HDMI. Are you on the PC or HDMI?
HDMI.
Are you on the PC?
HDMI.
I don't know, people were having a hard time with that. So you plugged your HDMI into your computer? Or are you doing it off the PC?
Yeah, we do,
Is he on the PC? I remember you wanted to give me an idea of what the portfolio is.
Oh, like depends.
You don't really speak. And speak loud.
Hi, so this derivative trading corp, and I'm going to present you our active diversified portfolio. So we recommend this portfolio product, which has a moderate to low risk and moderate to high return of 9% to 10% over the holding period with a yield of 0.87. And then our targeted investor segments are institutional 16%, tech at 12%, consumer defensive 11%, and consumer cynical at 2%, and they are all large market cap. And the largest holdings are Omega Healthcare Investors at 22%, Northrop Grumman at 18%, HCA Healthcare 16%, General Dynamics at 15%, and Facebook at 12%. And here's our portfolio performance. So in our back test and front test, the highest alpha we got is the first year return, which is 16, 15 beta points, and the lowest is the 3-month forward, which is quite off, which is negative 10 to 17 beta points. So our target market will be 50-50 split of institutional and retail investors, and our target AUM of 3 billion portfolio within 5 years, and then our desired holding periods of 5+ years for retail and 15 or more for institutional investors. And we are targeting investors who are desiring stable long-term returns. For example, company retirement accounts, pension funds, and 401ks, IRAs, ETFs, and high net or ultra high net worth investors and family offices. And here's our fee structure breakdown. So first of all, the structure is active, and then AUM 3 billion. The fee is 1%, and our fee revenue will be 30 million. And here's our recommendation again. We recommend this portfolio, and we'll target a moderate to low risk and a moderate to high return of 9% to 10% over the holding period. And then our target investors will be institutional and retail clients of totaling 3 billion AUM portfolio within 3 to 5 years, and with the fee structure of 1%, which will generate around 30 million revenue. And I'm Douglas Chan, the portfolio manager, and Suji Foley and Andrea Wang are my members who are the senior equity analysts.
What's a CTP?
I forgot.
Did you mean CFP?
Not sure.
Yeah.
Certified treasury professional.
Yeah, and change it to CMP. And then go to the beginning. Next. 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 Next.
Oh my God, make this end.
Next.
The thing I'm doing, not your
That's
presentation.
okay. So over the 5 to 10 year period, you underperform the market. Okay. At a lower risk. Okay. So you're basically selling an index portfolio because there's no alpha. And these are too short a time periods to really take seriously. So basically what you're selling is a market performance, market index, market return, credit lower risk. So what you need to say is moderate to high risk adjusted rates of return.
Oh, sorry.
Okay. Next. For a portfolio that doesn't generate alpha over the long run, you're not going to be able to generate $3 billion. Okay. So you're going to have to take that down. Okay. Go to the next. And then you're probably, if you're going to do an index portfolio, you could probably charge a point. But this is an active portfolio that's getting the index. So why would I pay you higher fees when you can't even beat the benchmark? Right? So you're giving us basically the benchmark return, but at lower risk than the benchmark, than the market. So you're giving us a higher risk adjusted rate of return. So you're giving us the index return, but at lower risk. That's what you're selling.
I guess I will adjust the weights again.
Well, it's your stop picks, right?
Yeah.
And then it's based on the long-term performance of the stocks that you have in your portfolio. But your portfolio is defensive, right?
Yeah.
Yeah. I mean, you're not tech or defense oriented. You're defensive. So the value that you're giving is I can get you the index at lower risk. So you can give me basically the index return at a higher risk adjusted rate of return. That's what you're selling me. Okay, I think you can get away with it. 1%, maybe. Okay. Maybe. Leave it at 1%, but it's probably 75 basis points. But you can just keep it at that. Okay. But it's going to be hard to sell this as an active portfolio, right? Because you would assume that it would generate alpha over the long run if it was an active portfolio. Right? Higher return, higher risk.
To be optimized.
Yeah. So it's just because of the composition of your stocks. So that's how you have to sell it. So keep going. Okay, keep going. Okay, that's it. Okay, that's my feedback.
Do you understand that?
All right, I don't know about you, but I'm tired.
Explain
I'm
it.
done. I gotta go eat pizza.
That's good.
We're getting pizza.